What if I told you there's a simple math rule that Wall Street pros use to estimate how fast their money can double? And you can use it too, even with just $100. It's not a gimmick, it's the power of compound interest, famously called the eighth wonder of the world. I put this principle to the test with a real $100 experiment, documenting every step to see if this rule could actually help an ordinary person grow their money. By the end, you'll know the rule of 72 and see how it can guide your own financial journey. Ready? Let's dive in. The rule of 72 is a classic shortcut in personal finance designed to help you quickly estimate how long it will take for your investment to double, given a fixed annual rate of return. Instead of getting bogged down in complex math or using a financial calculator, this rule gives you a fast, back-of-the-envelope calculation that anyone can use. It's a favorite among financial planners and investors because it's so easy to remember and apply, whether you're planning for retirement, saving for a big purchase, or just curious about how your money can grow over time. The process is simple. Just take the number 72 and divide it by your annual interest rate. The answer tells you approximately how many years it will take for your money to double. No complicated formulas, no spreadsheets, just a single, easy calculation. For example, let's say you're earning a 6% annual return on your investment. Divide 72 by 6, and you get 12. That means it will take about 12 years for your money to double at that rate. This quick calculation can help you visualize the power of compounding interest, and see how even modest returns can make a big difference over time. Now, if you find an investment that offers a 10% annual return, the math is just as easy. 72 divided by 10 equals 7.2, so your money would double in just over 7 years. This can be a real eye-opener, showing how even a few percentage points difference in return can dramatically speed up your financial growth. The rule of 72 works in reverse too. If you have a specific goal in mind, say you want to double your money in 9 years, just divide 72 by 9. The answer is 8, which means you'd need an 8% annual return to reach your goal. This flexibility makes the rule a handy tool for both planning and evaluating different investment opportunities. While the rule of 72 isn't perfectly precise, especially for very high or very low interest rates, it's accurate enough for most everyday decisions. It's a great way to quickly compare different savings accounts, investment funds, or even debt repayment strategies, and to set realistic, achievable financial goals for yourself and your family. In short, the rule of 72 transforms confusing financial jargon into clear, actionable targets. It empowers you to make smarter decisions, set meaningful goals, and take control of your financial future, all with a simple calculation you can do in your head. With the rule of 72 in my toolkit, I decided to put my $100 to the test. But instead of putting all my eggs in one basket, I wanted to see how different strategies would play out in real life. So, I split the money into 3 distinct buckets, each representing a unique approach to growing wealth. My goal was simple: to learn, experiment, and discover which path could help me double my money the fastest, and what lessons I'd pick up along the way. The first $40 went into a high-yield savings account, offering a 4.5% annual percentage yield. This is the classic, safe and steady route. Think of it as the financial tortoise. It's protected, insured, and there's virtually no risk of losing your money. But the trade-off is time. At 4.5% APY, it would take about 16 years for my $40 to double, according to the rule of 72. This bucket is perfect for people who value security and want to see their money grow slowly but surely, without any surprises. It's not flashy, but it's reliable, and it's a great way to build a financial safety net. The second $40 went into growth stocks. This is the hare in our race. Fast, exciting, and a bit unpredictable. By investing in a diversified mix of stocks, I was aiming for an average return of about 12% per year. If the market cooperates, that means my money could double in just 6 years. Of course, with higher potential returns comes higher risk. The stock market can be volatile, and there's always a chance of losing money, especially in the short term. But for those willing to ride out the ups and downs, the rewards can be significant. This bucket is for people who are comfortable with risk and want to see their money work harder for them. The final $20 was my wild card, a bet on myself. I invested it in an online course focused on digital marketing and copywriting. Unlike the other 2 buckets, this one isn't about passive growth. It's about building skills that could help me earn more money in the future. By learning how to market products and write compelling copy, I could potentially create new income streams, land freelance gigs, or even start a side business. This approach is riskier in a different way. It requires time, effort, and discipline, but the upside is unlimited because the return depends on how much I apply what I learn. Each bucket represented a different philosophy: safety and security, risk and reward, and self-investment. By spreading my $100 across these three strategies, I could compare not just the numbers, but also the experience and personal growth that came with each choice. It was about more than just doubling my money. It was about understanding what kind of investor I wanted to be. My experiment was about more than just the end result. I wanted to track my progress, set clear goals, and reflect on what I was learning along the way. Would the steady path of savings win out? Would the stock market's roller coaster pay off? Or would investing in myself open doors I hadn't even imagined? Each path had its own risks, rewards, and lessons to offer. So in this race between the tortoise, the hare, and the wild card, which one will come out on top? Will slow and steady win? Will risk takers reap the biggest rewards? Or will betting on myself change the game entirely? Let's dive in and find out together. The first week was pure excitement. There's something electric about starting a new journey, especially when it's one you've been thinking about for ages. Every small step felt like a leap forward, and I couldn't help but feel a rush of anticipation each morning. The possibilities seemed endless, and I was eager to see what I could accomplish with just a bit of focus and determination. I checked my accounts daily, sometimes even more than once. Watching the numbers, no matter how small, became a ritual. It was almost like checking the weather, except this forecast was about my future. Each login brought a mix of hope and curiosity, as if something big could change overnight. The savings account earned a fraction of a cent, tiny, but proof that money can grow passively. It was almost comical to see such a small gain, but it was also strangely motivating. That little uptick, just a few cents, was a reminder that progress doesn't always come in big waves. Sometimes it's the slow drip that fills the bucket. My stocks jumped to $41.50, a quick 3.75% gain. It felt like I'd cracked some secret code, even though I knew luck played a part. Still, seeing that green arrow pointing up was a thrill. I started imagining what could happen if every week was like this, how quickly things could snowball if I just kept at it. I felt like a genius, momentarily. It's funny how a small win can inflate your confidence. For a brief moment, I pictured myself as a savvy investor, someone who always made the right moves. But deep down, I knew this was just the beginning, and there was so much more to learn. Meanwhile, I dove into the $20 course, learning the basics of copywriting and connecting with a mentor who gave me actionable advice. The course was packed with insights, and every lesson felt like unlocking a new tool for my toolkit. My mentor's feedback was honest and direct, pushing me to think differently and challenge my assumptions. I started to see how these skills could open doors, not just for side income, but for a whole new way of thinking about work and value. By week's end, my portfolio was up to $101.55. Savings barely moved, stocks led the way, and the course filled me with ideas. I started jotting down plans, brainstorming ways to apply what I'd learned, and setting new goals for the weeks ahead. The numbers were small, but the sense of momentum was huge. It felt like I was building something real, one step at a time. The momentum was strong, and I was convinced I was on the right track. Every little win, every new insight, added fuel to the fire. I felt more motivated than ever, ready to tackle whatever came next. The excitement of starting was still fresh, and I wanted to make the most of it before reality set in. But the real test was yet to come. I knew that the first week is always the easiest, the honeymoon phase when everything feels possible and setbacks haven't arrived yet. I started to wonder how I'd handle the inevitable challenges, the slow days, and the moments when progress would stall. The easy part was over. Now, it was time to see if I could keep the momentum going when the novelty wore off and the real work began. Week 2 and 3 hit hard. The stock market tanked, and my $41.50 dropped to $36.80. A painful 8% loss. I wanted to sell but reminded myself, the rule of 72 is about the long game, not daily swings. The savings account kept inching up, now at $40.03. Slow, but steady. Suddenly, the tortoise looked smarter than the hare. Meanwhile, the course lost its shine. The middle modules felt generic, and I doubted if I'd ever make my $20 back. Doubt crept in. Was this all a waste? The goal of doubling my money felt further away than ever. I was in a slump, questioning every choice. Week 4 changed everything, not because of the market, but because I took action. I used the course to build a freelancer profile and pitch my services online. After 10 proposals, one client hired me for a $25 gig. I delivered, got paid, and suddenly, my $20 investment in myself had turned a profit. Meanwhile, the stock market rebounded and my portfolio climbed back to $42.10. The savings account kept its slow, steady pace. The lesson? The fastest growth came from investing in myself and taking action, not just waiting for the market. The finish line was in sight. After 30 days, here's how each bucket performed. The savings account, $40.15, safe but barely moved. The stocks, $42.10, more growth, but a wild ride. The course, $20 spent but $25 earned from freelancing. A $5 net profit and a new skill. Total $107.25. The investment in myself delivered the biggest return, both financially and personally. The experiment proved that calculated risks and self-investment can outpace traditional savings. Each approach had its place, but the real winner was taking action. The rule of 72 was just the starting point. The biggest lesson wasn't about which investment made the most money. It was about shifting from passive observer to active participant. The savings and stocks grew, or shrank, on their own, but freelancing happened because I acted. Investing in skills gave me control and opened new income streams. The rule of 72 is a great tool, but it only measures what you already have. The fastest way to grow a small sum? Invest in yourself, then use those earnings to fuel your investments. That's how you build a real wealth engine. Now it's your turn. The rule of 72 isn't just a formula, it's a mindset shift. Start with any amount, $100, $50, or $20. Use the rule to set goals and compare options. Try a mix, save savings, a bit in stocks, and invest in learning a new skill. Track your progress, learn from the journey, and don't be afraid to take action. The real reward is the confidence and clarity you gain. Share your story in the comments. Your experience could inspire someone else. Let's build a community of people actively creating their financial future. Thanks for watching. Smash that like button, and I'll see you in the next one.